Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets.
I'm Joann Spadigam, European rate strategist, and I'm joined today by our global market specialists, Stuart Sparks and Paul Robson. It's been quite an interesting week in markets this week with a lot going on, data in the UK, as well as some concerns around US fiscal policy. So I think let's start there with you, Paul. We had a bit of a surprise on UK CPI this week. What did you make of all of it?
Yeah, as you say, the CPI report in the UK was a surprise to markets. It was quite significantly stronger than expected. But I have to say it was a bit of a messy release. There was lots of moving parts. There always were going to be moving parts, and a lot of those surprised. The reason it was rather messy is because we had indexation. We had the sort of timing of Easter, which makes a huge difference to UK data. And of course, you had the national insurance and minimum wage changes and people revising their list prices. So all these came together. Headline inflation was significantly stronger than expected. Stripping out the sort of food and energy, it was a little bit more in line with expectations. The big surprise was airfares. That was the timing of Easter. They shot up 16%. I don't think people really think that that's going to be sustained. So inflation coming down in later months. But I think the key takeaway for me is that service sector inflation was still very sticky at sort of 5%. I think anyone that's looking for the Bank of England to ease monetary policy more quickly than is currently surprised. I think this was just a very uncomfortable set of numbers. So as I say, inflation should come down in the next month as some of these seasonal impacts unwind, but you're going to be left, I think, with uncomfortably high inflation for the MPC and markets, really.
So the other piece of information we got this week was also the UK public finances data. Was there anything there that was particularly interesting to you?
Well, I thought they were equally as messy as the inflation numbers. I think trying to pick through the various parts of the report. So two numbers that we look at, but we've got the general government net cash requirement number and the government net borrowing numbers. Net borrowing sort of gives you a better idea of underlying trends in government borrowing requirements. The other measure more important for gilts. The first measure, net borrowing, was sort of quite noticeably sort of higher than expected, but you had previous months revised down, so net probably in line. On the other measure, net cash requirement, that was actually a little bit better than expected. But I think if you put it all together, the takeaway really is that there's been no noticeable improvement in the government's finance position. And that's obviously important given what bond markets are doing at the moment. If we delve into the numbers a little bit more carefully, tax receipts, yeah, they're growing pretty well, but it's spending that's staying high, and this interest rate or debt servicing cost for the government continues to be sort of a heavy weight. So putting those together, it's still a long way to go to get the UK's public finances on a sustainable footing. And I think ultimately that was the key takeaway from that report.
So the data this week are clearly going to have some implications for the MPC and the reaction function there. We've heard quite a lot from Pale this week, who may now be the leading hawk. So what do you make of all of this in its context?
Yeah, like you said, we actually heard from him twice. I actually think the sort of headlines were really overstating any sort of shifts in his sort of policy bias, if you like. I think all he was saying was that inflation in the UK has become a little bit more structural. He's a little bit more worried about the wage and price formation in the UK, and it just demanded a slightly slower pace of easing monetary policy from the Bank of England. And anyone who'd been listening to him over the last year, I think that's always been the key takeaway. He obviously is chief economist of the Bank of England. He relies on his models, and they are telling him that inflation's a little bit sticky, and given the inflation numbers that we had this week, I think that's strongly supportive of what he was saying. He also said that he wanted rates to have sort of peaked at a slightly higher rate and stayed there for longer, just making sure that inflation comes out of the system. So now he thinks that rates will have to come down a little bit more slowly. And here, but I think the key takeaway is that he was talking about a skip a meeting that other people in the MPC voted for lower interest rates. So ultimately, he thinks that interest rates need to come down just a little bit later. So we think that the Bank of England should be cutting in August. And I think overall, front-end rates just look a little bit hawkishly priced to me, especially August now at just over 13 basis points. So either they're going to cut or they're going by 25 or they're not. And the risk reward, I think, favours a 25 basis point cut and follow up one later in the year.
So as you said, the front end does seem a little bit hawkish now versus our expectations, but the long end also has seen rates continuing to rise there. What do you make of the long end at this current situation?
Yeah, I think it looks equally fairly priced or better priced. So the rise in 10-year yields has come back in line with our estimate or our target of fair value, and that leaves the risks a little bit more balanced for the long end. I don't think there's been any sort of change in the UK backdrop to warrant significantly higher yields at this point. So I don't have any plans of moving that target sort of over the short term unless something changes. I'd note the sort of rising correlation with what's happening in the US and the US curve. I'm extremely happy that Stuart's on this week's podcast, so I'm hoping that he's going to give me a little bit steer on where 10-year UK is going, but ultimately better balanced. I think for the UK, when we've been up at these levels before, we have seen returning demand, most obviously in January. But what we had then was some better CPI numbers, both in the UK and the US. You had a return to buying, and Treasury markets rallied as well, and that took out the pressure into the UK curve. Given again what we've had inflation, we didn't get that support. So I think very much watching what's happening on the US curve, and that will give us a guide on the long end of the UK.
Thanks, Paul. Perfect segue to Stuart to talk about the US a little bit. So I think there's been a couple of things in focus this week. Firstly, the downgrade by Moody's last Friday, as well as the US tax bill, which has been moving swiftly. How are you seeing the progress in fiscal policy in the US? And are you concerned about recent market moves, which are clearly showing a bit of concern on fiscal policy at this point?
Yes, I mean, we absolutely see market strains emerging. Our take on this is, at the end of the day, it's ultimately an issue of inflation confidence, or confidence in the Fed's willingness to defend the inflation mandate. Interestingly, though, the problem is surfacing at the same time as fiscal negotiations and some supply pressure. So last Friday, we had a downgrade. I think it's sort of immaterial. The last of three agencies to do it. We don't really see much market impact on balance, but the bigger issue has been a bearish steepening of the term premium. And this is clearly to do with debt sustainability, among other things. The CBO's most recent long-term budget forecasts highlight that the growth rate of debt will exceed the growth rate of GDP as of 2044, which is the definition of unsustainability for debt. And so this spending package is being seen as a bit of a straw that breaks the camel's back. You've seen a bit of a liquidity hole around the long end. The reason this becomes more broadly relevant is because it is that real term premium which was depressed by financial or by QE in order to force investors into risk assets, so equities and credit, prepayment risk, et cetera. And what we found is that with supply pressure, with constrained dealers, with questions about inflation, the market has stepped back, and ultimately, we think what's going on is the market has perceived a greater risk of soft default vis-a-vis hard default. So it's not whether or not the U.S. will pay nominal obligations, irrespective of the debt ceiling. It's now must the U.S., given its debt dynamics, be forced to monetize, and if that risk is seen to be acute, then naturally, longer creditors at the longer end of the yield curve will tend to shy away. This credit piles up on dealer balance sheets. Illiquidity premia, have emerged and grow more pronounced, et cetera, et cetera. So, we think that ultimately more clarity on the inflation front would assist all of these, in the sense that it would decrease the market's perception of the risk of soft default. There are questions as to whether or not there are policy tools that could be deployed in more of a liquidity emergency. I think there absolutely are. Again, our sense is that we won't get there. Ultimately, the Fed is going to have to reassert itself on the inflation front. And I suspect that these tensions will ease.
So you mentioned the supply pressures on the long end just now. We did have a US 20-year auction that was a little bit soft this week. How are you balancing the risks of supply along with our more hawkish Fed view in terms of our view on the shape of the curve going forward?
A lot of the murky elements and pricing anomalies that we're seeing, we think ultimately can be explained, through inflation. So it's ultimately this issue of confidence. And what we're seeing is the original budget proposals were between 3.8 and 5.8 trillion in spending authority. The package that has been passed by the House is somewhere in between, so it could have been much worse. The issue is just that given additional deficit spending, this crossover point between this debt sustainability crossover point will obviously move closer in time. So, there are a lot of various tools to be deployed, but ultimately these are temporary measures, and the ultimate issue is expenditure. Very difficult. I mean, obviously the Trump administration is trying to expand the tax base, but lower rates on the margin. They were, I would say, generally successful in that endeavor in the first term. But ultimately, the pressure is on either this administration or those in the future to address entitlements. It's obviously political kryptonite, and it will be the last thing confronted. But again, particularly in light of demographics, it's probably the most salient issue. So all of this is prelude to a bigger adjustment which needs to be made. And I would say this is not just a U.S. issue. The long end weakness across the global markets, I think is ultimately a reflection of these same basic issues: high levels of indebtedness, demographic issues, problems with long-term potential growth, et cetera, et cetera. So we're looking for temporary measures to kick the can down the road. But there is an ultimate day of reckoning, which is likely not here. But that will require, I think, remarkable political consensus, which simply doesn't exist at this point. So in the short run, it's going to be a question of the least bad set of measures applied to the economy, more or less doing all the things that in the long run will not work, just as a means of delaying addressing the issue that would work.
Thanks, Stuart. That's all very interesting and super clear. It does seem like all roads lead back into inflation and Fed credibility on the line, and let's see what happens in terms of how they tackle that. But certainly, I'm sort of happy to hear that you were saying easing tensions potentially at some point. Let's just, I guess, waiting for that point to be reached. Maybe it's a good opportunity to move back into Europe. It seems that global and sort of local domestic factors were driving European curves this week. Just wondering, Joann, how you're seeing the relative balance of that, and where do we go from here?
So, I mean, I think the moves we've seen this week have clearly been fairly well aligned with our steepener that we've been talking about for quite a while now. I think on the global front, this week was a pretty good reminder that whilst the Germans have had a safe haven status for quite some time now, with US trade policy really pushing flows to bonds, the euro area is just not isolated from the impact that is global supply and the global glut of supply that will come both in terms of the US, but also the UK and the euro area. So that supply picture is obviously pretty important, and I think that will be something that we're watching in Europe as well as the US going forward. And that correlation is clearly quite strong when it comes to fiscal policy. So that term premium fiscal policy story has played out quite well versus our own views. And I think the domestic factors this week has also helped with that. I think firstly, the European PMIs this morning were not particularly impressive. I think we're still in that area where European growth is improving, but not quite good enough for markets to be getting super bad up. I think for now, the risk for the very front end of the curve remains that actually there are still lots of uncertainties around the growth picture in Europe, both because of local factors such as whether savings will actually translate into spending, as well as the fact that there's still this global uncertainty with tariffs that will keep the front end a little bit lower than our 2% target at this point. And the PMIs help to re-emphasize that story for the front end this week. On the domestic side, the other thing that was important this week was on Dutch pension fund reform. So this has been something that has been causing a little bit of uncertainty in markets over the last few months. The key development of this week is that essentially the vote that would have delayed pension fund transition has been declined. So now what we're seeing is that Dutch pension fund transition will happen as expected, the move from defined benefit to defined contribution. Pension funds are essentially pretty big players in the ultra long interest rate swaps market and in long interest rate swaps in general, because they do have to account for the asset liability management of a fairly long duration portfolio. And because of the move to defined benefit, that mix of assets is changing, which means that they will have to invest less in the very long end. So markets have really been given the green light in the recent week to go ahead and steepen the curve based on the fact that pension funds will essentially just be demanding less long end duration. And that, I think, is a theme that will continue to play out for the next few years at least. To me, there's still some time to go before this theme becomes very live, just because the biggest pension funds in the Netherlands are only due to transition in 2026 and 2027. So I definitely think that this is more of an end of year story versus now, but it definitely does help the case once again for curve steepening in Europe.
Interesting. You started there by saying the sort of little bit of contagion from what we're seeing in the US impacting European markets. I was interested to see that Italy was actually trading pretty well through all this. So I'm just curious about what you think were the drivers of that, and whether you think that spreads can continue to tighten.
Yeah, the story in BTPs has been super interesting, particularly after the US-China trade tensions reduced a little bit. And I think that that's because BTPs have essentially traded a little bit just like a risk asset in the initial risk-off period, and then they've tightened back down. And I think that in general, I do agree that the tightening makes a lot of sense, right? I think firstly, there's been a pretty positive story in terms of Italian debt and Italian debt metrics. I think secondly, there's obviously been a pretty positive seasonal factor coming forward in June and July, which once again helps this tightening story. Thirdly, I think that there's also this retail story, and we will get a new retail BTP next week, the BTP Italia, which again could re-emphasize this pretty strong retail buying story in Italy, which has also helped. So I think overall, even though we've seen BTPs tighten quite a lot, I definitely think that there's still room for this to run. We've had pretty positive ratings actions on Italy as well, with a surprise upgrade a few months ago by the S&P, and another rating review due this Friday, where again I expect positive action. So for me, the BTP story does continue to be pretty positive, and the fact that Europe is once again united together against forces from around the world and from the US as well, does play quite positively for the European story as a whole. And of course, German fiscal spending will have implications which hopefully will be positive for the rest of the euro area as well. So I think for now, the BTP story to me continues to be quite positive, and I continue to see further tightening to come for Italy. I'll leave it at that. Thank you both for joining me, and thank you to our listeners for listening. If you did enjoy this episode, please don't forget to subscribe. Speak next week.